up 7.5 and up 4.9. Both begin with an N. I'm excited. The Nikkei. And of course, those of you who chose the NASDAQ, you get a round of applause like you do. To make you all feel better, loyal skunk. Now, in order, we're not going to do it. All right. So, in order to sort of act as an antidote to those of you who successfully chose the Nikkei, and who now think perhaps you have some great skill in picking good investments, we're going to talk today about market efficiency and try to convince you, I'm going to try to convince you that it's very difficult to disentangle skill from luck. And that will sort of add a dose of humility, which is probably the most important thing you need when you start to invest your own money. So here's what we're going to do today. Again, we're not going to do a review of options we did at the end of last time. We're going to talk about efficiency. I'm going to spend a couple of minutes on what it means. And then we're quickly going to go to empirical evidence. So it really is, are markets efficient? Once we know what it means, are they efficient? And that's done in 3 steps. The first step is something called weak form efficiency. The second step is called semi-strong form efficiency, and there we're going to deal with event studies and anomalies. And then finally, we're going to talk about strong form efficiency and mutual fund performance. So that's the outline of market efficiency. And at the end, I'm going to do 2 summaries. The first summary, 2 9-minute summaries, okay? This one's going to take 9 minutes. A 9-minute summary of the entire semester. This is like the mother of all summaries, okay? So the whole semester in 9 minutes. And then investment strategy. So in other words, we've done a lot of our examples of present value and option value and all that dealt with investment strategy. So I'm going to give you some of the takeaways. Fine, we're going to deal with takeaways on investment strategy. All right, so let's start with market efficiency. I'm going to give you a definition of market efficiency. And here's what I'm going to suggest. I'm going to give you a definition, then I'm going to do some empirical evidence. To A, B, and C should take me about 40 minutes to do. And what I'm going to ask you to do is hold your questions, hold your what if, what about that, and what about this until the end, until those 40 minutes are up. And that's because I'm probably going to cover things later that you're going to ask me about in the beginning. You know, is this possible? Is that possible? So let me go through it, unless there's like a point of order or something that, you know, I was saying something that was incomprehensible. Then you can raise your hand and say, you know, what does that mean? But no questions about what about this or what about that, because after we finish this, I'll open it up and we'll have about 15 minutes to go through all sorts of questions on market efficiency. So if there's something that you're thinking about that I don't answer, right? Something that you're thinking about, write it down. And then after the first 40 minutes, we'll open it up for questions, and then we'll go to these last 2, which take about 20 minutes. Okay, so it's a slightly different plan, but I think it'll work better than if you say, well, you know, how about talking about something else? So the definition of market efficiency is really very simple. A market is efficient when the price of the asset fully reflects all available information. We're talking about the market for an asset or for a security, financial asset. Very simple. Market is efficient if the price fully reflects all available information. Now, there's usually a big screaming and yelling, a confrontation between academics and practitioners over market efficiency. And so the question often is asked, is this purely an academic concept? Is the concept market efficiency purely academic? And the answer is no. Practitioners use it all the time, except they call it something different. When they say the price has already discounted that information. And you hear that all the time. Security, the price already discounted that. What does that mean? The price has already reflected that information. It's already impounded in the price. The market is efficient with respect to that information. So what's all the fighting about? So why are there, why do the practitioners say the academics are crazy when they talk about market efficiency? And the answer is, academics tend to believe almost all publicly available information is embedded in stock prices already. So in other words, the market is efficient with respect to all publicly available information. Practitioners say, yeah, that's true, except for what I know. So in other words, they say, well, we know something. I, the individual, know something that other people don't, and we can therefore act on that information and earn abnormal returns. Academics say, show me. They're cynics they're skeptics about that. Let me just, one bit of information that people have an incorrect view of. Academics do not say, do not say, no one can ever outperform the market. I'll say it again. Academics do not say that efficiency means no one can ever outperform the market. What are we? We are skeptical that it can be done very carefully, consistently, on a risk-adjusted basis after transactions costs. And of course, you recognize very clearly on a risk-adjusted basis, suppose I told you that my rich uncle earned twice as much as the S&P 500 over the past 2 years. And what do I say? Well, what was the beta of his portfolio? If the beta of his portfolio was 2, then he should have earned. If the beta of his portfolio was 3, he underperformed. So you have to do this consistently on a risk-adjusted basis after transactions costs. What does consistently mean? 1 month doesn't make you a genius, okay? So consistently has to be over a long period of time. How long a period? Long. 5 years, show me, and then I'll start thinking about it. Why do academics believe that markets are efficient? And the answer is because of the competitive pursuit of profit. So for example, what if an announcement by Amazon was, what if the price of Amazon ignored an announcement that Amazon discovered a way to make oil out of used textbooks? Suppose they announced that as a marketing activity. Well, what would we all do? We would all go out and buy Amazon stock. Why is that? It's cheap, given that information. What does everybody's buying do? Drive up the price. When does the price stop going up? When the price reflects that publicly available information in 2 respects. How correct is it? And what is the likely impact on Amazon's cash flows? So the price fully reflects doesn't necessarily have to mean it will in fact turn out to be exactly what happens. It just means it reflects in a probabilistic way the information, its veracity, as well as its likely impact on future cash flows. So what I want to do now, so that's what efficiency means, what it doesn't mean. And now what I'd like to do is take you through the various tests. Are markets efficient or are they not efficient? So first, this is done in a number of layers, and the layers are primarily historical. So let's start out with weak form efficiency. Weak form efficiency is called weak because it refers to only one very narrowly defined bit of public information, and that is the history of prices. So weak form efficiency, remember I said that prices fully reflect all publicly available information. Well, what publicly available information are we talking about? Weak form efficiency only tests for efficiency with respect to the history of prices. What does that mean? The price of IBM fully reflects all the history of prices of IBM. The price of gold fully reflects all the history of the price of gold. And so you would say, well, should you be surprised at that? The answer is no. Why is that? Suppose I told you, if you pay me $100, I will tell you what IBM's dividends were last year. You say, well, that's ridiculous. Why is that? Why do I care what it was last year? After all, we've already reacted to that. So why would you think you could earn abnormal returns, which means you pay somebody for the history of prices? People already know that information. And the problem is that there are lots of people who think they can extract information from the history of prices because the history of prices is also the history of returns. Think of returns. Returns are PT minus 1 over PT minus 1. So the history of prices also includes returns, and that there are lots of people that think high returns in the past mean high returns in the future, including a whole bunch of people in this room. So why do we say, oh, history of price is ridiculous? Don't high returns mean high returns in the future? What do the academics say? If everybody knew that high returns in the past meant you would earn high returns in the future, what would every single person do? Well, if I see a stock that has a high return, what will I'm going to go out and buy it. Who else is going to go out and buy it? So is everybody else. And therefore, what happens to the price? It goes up. When does it stop going up? When all the information that high returns in the past means high returns in the future are embedded in the stock price. So that's why, if we all know something is true, you can't extract abnormal profits. Why is that? Everybody is going to try to act, everybody's looking to make what? Extra money, and therefore investors will try to extract that information, and the price reflects that information. So the question really is this true? What's the evidence? Are prices, are returns, and here's a word that sometimes you will hear, are returns serially correlated? What is serially correlated? That's with an S, not with a C. What is serially correlated? Are they correlated through time? Okay? And the major evidence is they are not. In other words, we can reject the hypothesis that returns are serially correlated. That doesn't mean that on 1 month you don't see a high return, and the next month you see a high return. It could be what? Accidental. There is no persistence in returns. Now that was what I would call the old evidence. There's new evidence that there is such a thing, and I'm going to use 2 words. Momentum in stock prices. Momentum means what? If it starts to go up, it'll continue to go up. There's also another bit of evidence called there is reversion in returns. What does that mean? If it goes up, it's going to go down. So there is some evidence of both of those, and I am going to call that kind of evidence as anomalies. Why is it an anomaly? It's a surprise. We just said that if everybody knew that returns were going to go up, if they were high, they were going to continue, we would all buy the stock. And that should be embedded in the price. So there is some evidence, and I'm going to talk about it when I talk about semi-strong form under anomalies. So what is the evidence on weak form efficiency? The old evidence is no serial correlation. High returns can't tell you anything about the future. There is some evidence that there is momentum, and some that there's reversion, which means that's maybe those two cancel one another. The evidence is unclear. People call them anomalies, and I will talk about that. All right, that's weak form efficiency. Now let's turn to semi-strong form. Semi-strong form is much more expansive. What does semi-strong form efficiency mean? Literally, stock prices fully reflect all publicly available information. Underline the word all. Any information that is public is embedded in stock prices. What's the reason for this? People are always looking for scraps of information to do what? Earn abnormal returns. So everybody's trying to use that information, and that's how the information gets embedded in stock prices. So stock prices fully reflect all. Now, all publicly available information is what? A lot of information, isn't that right? Anything that's public is embedded in stock prices. So how do you test this? The answer is you test it one piece of information at a time. So in other words, you ask the question, for example, are dividend increases, is the announcement of a dividend increase embedded in stock prices, or can you earn abnormal returns by investing in companies that have just announced an increase in dividends? Suppose you reject that. Suppose you say you can't. Well, you haven't proven that the market is efficient. You have just done what? Failed to reject that hypothesis. I hate to do that, and you heard about that in statistics, but it's true. So even if I show you that you can't earn abnormal returns by investing in companies that have announced dividend increases, all I've shown you is you can't reject the hypothesis that markets are efficient, but you haven't proved that. So we do this one piece of information at a time. I gave you one example, dividend increases. Another example is people look at stock splits. When a company announces a stock split, in other words, it says, all right, instead of you're holding 1 share of IBM, you're not getting 2 shares. Holding 1 share of Apple, you're not getting 2 shares. What do they do that for? To lower the price so that people can buy more shares and not spend the same amount of money. So in other words, instead of buying 2 shares of Apple, you could buy 50 shares of Apple if they do a 25-to-1 stock split. So this broadens the market, and people say, "Oh, that's good for the stock price." Question: if you bought stocks that announced stock splits, would you earn abnormal returns? How about if you bought stocks that just announced abnormally high earnings? So you take a survey of all security analysts. They expect the company to earn 10% this year. In fact, it earns 22%. If you took all those companies that doubled what people expect, would you earn abnormal returns? If a company announces a 10% stakeholder has just bought, that's good. You have to file a 13D. So in other words, if one company buys the larger, more than 10%, it's 10%. Everybody knows this. So it's above 10%, then you have to make a public filing with the SEC. So I will know, for example, if Carl Icahn buys a 10% stakehold in Exxon. Why has to make it publicly available, a public filing? What does that mean? Oh, if he likes it, why shouldn't I like it? So if you did, in fact, bought all those companies that had a 13D announcement, would you earn abnormal returns? That's what semi-strong form efficiency looks at. Each piece of information, one at a time. And what I'm going to do right now is show you how we test that. We test it using event studies. And the reason I'm going to show you an event study, what it is first of all, you should know how they test it. And second, if you understand how it's tested, you understand what it means and what it doesn't mean. So here's what we do. We take a piece of information that we're interested in. Let's call it stock splits. And we say, let's get all companies that announced a stock split between the year 2000 and 2010. Why do I take all of them? Because I guarantee you, if you pick 4 of them and you want to show that that it earned abnormal returns, you could pick 4 stocks that would earn abnormal returns. So what I want to do is say, no. You can't carefully select your sample, take a time period, and get all the companies that have announced the stock split. And that means you have, let's say, 1,000 companies over between 2000 and 2010 that have announced the stock split. Then you line them up and call, this is time, this is day 0. That's the day of the announcement. So now I have 1,000 companies, and I've lined up each one as called it day 0, the day of the announcement. And then I ask, this is the question that we're trying to test. Suppose at the end of the day, at the end of day 0, what was day 0? The day that the company made the announcement. I buy the stock at PT, which is the closing price that day. So in other words, I look at the closing price of the day the announcement occurred. and I say, if I buy at that price and I hold it, let's say, for 1 day, would I earn abnormal returns? If I buy it and I hold it for 1 week, would I earn abnormal returns? How about 1 month? And how about 1 year? So what I look at is does, listen carefully, does the closing price on the day of the announcement fully reflect all the available information? If it does not, if that closing price does not reflect that information, then I should earn what? Abnormal returns by buying at the closing price that day and holding it for some time period going forward. And I want to do is calculate the returns. You can do it over any interval, a 1 day, a 1 week, a 1 month, and 1 year. And I want to see whether, if I followed that strategy in all 1,000 companies that had the exact same announcement, would I earn abnormal returns? If I can't earn abnormal returns, what have I done? I have shown that the announcement is fully reflected in what? The closing price that day. Because I can't earn abnormal returns. If I can earn abnormal returns, that means the closing price doesn't reflect all available information. If the closing price does, the market is, the closing price is what? Efficient. What has it done? Incorporated all the information in the announcement. So you can do this over any time period. So let's just talk about 1 day, okay? So what I'm looking at is the return after 1 day. They announced it this way. Now I have 1,000 companies, and I have 1,000 returns. So the question is, do I get positive abnormal profits? So the question then is, well, what's normal profits? Well, I know what normal profits is. How do you do it? I'm going to subtract out RF plus RM minus RF times the company's beta. Why is that? That's what it's entitled to earn on any particular day. Isn't that right? I know what a company is supposed to earn on any particular day. It's supposed to earn whatever the beta return is, equity, and the equity premium. So what I do is, for every company, I calculate what we call excess return. What's the excess return? The extra return over and above what you would be entitled to based on the riskiness of the company. And what's the test? The test is the sum of all those excess returns that I'm going to call E sub I, the excess return of company I, is the sum of all those excess returns greater than 0. And if the sum, all right. I would hope whoever did that will in fact come up and sign up for next year. You will all listen. You will get an invitation. Very nice. Give them a round of applause. Bucky, are you running for like an office, so you want the publicity? Good. Then it will serve a higher purpose as well. All right. So now the sum of all those excess returns, is it 5? So we've done tests of this for all sorts of information. And in point of fact, you do not earn abnormal returns. For the vast majority of publicly available information, if you invest in all the companies that were subject to this announcement, you do not earn abnormal returns. Listen very carefully. This does not mean that you can't pick 1, 2, 5, or 10 companies that the next day earn abnormal returns. All it means is that you pick those 10, I can look back and see which ones outperformed, but I guarantee you for the rest, you would have at least as many that earn less. So you can go back and cherry pick what you like. That does not prove that the market is not efficient. What you have to do is, let's take all the data and see whether you could in fact use that information as an investment strategy. Want to look at the individual companies? Fine. So, are there examples when the price continues to go up after an earnings announcement, after a 13D filing, after a dividend increase? Absolutely. That's not proof that the market is not efficient. This is what? A random result. Okay? So now, this is overwhelmingly that what? Prices at the end of the day are what? Efficient with respect to publicly available information. And all I can tell you is, once again, there are some exceptions. There are anomalies, exceptions to this outcome, and I will talk about them once again. I will talk about them again. Sarah.
Can you take into account length of time in this case? So if you had excess returns in a day, would that be enough to prove that the market was efficient?
So if you had excess returns over one day,
right,
that would say that the closing price is not efficient. And by the way, and you can do this over one day, 1 week, 1 month, 1 year. You do it with respect to the closing price. Some people have actually done this for the price 15 minutes after the announcement and have found after 15 minutes you get nothing. So in other words, not only is the closing price reflected, so is what? The price within 15 minutes. And by the way, that doesn't necessarily mean it has accurately reflected the information that's gonna continue. It means based on the announcement, can you earn abnormal returns? And the answer seems to be no, even for 15 minutes. Let me just, again, there are some exceptions, and I will talk about them. The exceptions are called anomalies. Why are they anomalies? Because we're surprised, given how many people look at all the information and invest in it. Let me just say one other result of this: prices at the end of the day fully reflect all available information. Think about what this implies for price changes going forward. In other words, if the end of the prices reflect all information, what's going to affect, and I'll use a fairly technical term, the evolution of stock prices through time. What does that mean? How stock prices move through time. So do stock prices follow trends or not? How do they move through time? If the closing price fully reflects all available information, so the market is efficient, then what affects stock prices? Only surprises, only news, isn't that right? News is by definition a surprise. Why is that? Otherwise it would be called olds, and it's not. Okay? So news is a surprise, okay? And if news is a surprise, that means it is random. You can't anticipate the news. Otherwise it's not news. News is random. Therefore, stock prices follow, listen carefully, something called a random walk. You may have heard that term. What's a random walk? Price changes are uncorrelated one day to the next. And practitioners say, well, that's because academics, how can they say the market's efficient if it follows a random walk? And the answer is, that's why it follows a random walk. It's efficient at the end of the day. That means what happens next? Only surprises, only price changes. Price changes and respond to news. All right, so that's the information that event studies give us. So now I'm going to turn to the anomalies. Before I do strong form efficiency, let me turn to the anomalies. Why is that? That's what you're waiting for. Well, I mean, where are the exceptions? How do we make some money by looking at publicly available information? So I'm going to give you some of the anomalies. I'm going to give you 2 anomalies. And I'm also, of course, going to give you the cautionary tale that you have to use when you look at the anomalies. Despite every anomaly that I talk about, and that you ever hear anyone talk about, the following 3 things remain true, despite the anomalies. Ready? 1, your broker knows nothing. That's true. Why? If your broker says, this is information and buy the stock, he says it, everybody knows it, and I guarantee you it's in the stock price. Second, never, ever, and you can underline ever as many times as you want. It doesn't, it's never enough if you underline it, okay? Never ever do what it says in the newspaper. Why is that? If it says a newspaper, it's history over it. Everybody knows it. If everybody knows it, I guarantee you it's in the stock price in a probabilistic way. Don't, if the newspaper says this is a great stock, do not buy it. In fact, what you might want to do is sell it because other people will buy it. And finally, be a skeptic. Be a skeptic when somebody has some information that you should use to be an investor, especially if what's true. They ask you for some money to invest with them, and especially if you're worried about whether that person might go to jail. Okay? So, be very careful when you hear about information, either from your broker or publicly available information. It is almost certainly the stock price. If they ask for money, say thank you very much. Don't even invite me for dinner either. So now, what I want to do is show you the anomalies. There are exceptions to what? To the evidence of market efficiency. What does that mean? There are exceptions to the evidence that you cannot earn abnormal returns. And I'm going to give you two examples of the possibility of earning abnormal returns. One is called the January effect. The January effect is also sometimes called the small firm effect. Why is it called the small firm effect? Because it's about small firms in January. Okay? It's about small firms in January, and you can think of this as leading to the following investment strategy. Small is beautiful. Why is that? Yes, okay. So why is that? Well, what happens in January? If you array the stocks on the New York Stock Exchange or in the Russell 2000, I don't care, whatever stock index you use, go for, break it up into deciles from highest market capitalization. What's market capitalization? Price times the number of shares outstanding. From highest market capitalization, the top 10%, to the bottom 10%. If you buy the bottom 10%, the smallest firms, listen carefully, sell short the highest 10%, which means what? You have zero investment, isn't that right? You don't invest any money because you're selling short instead of finance, you're buying the smallest. You earn, listen carefully, if you do that on December 31st, by January 31st, if you had done that over the past 30 years, since 1980, if you had done it, you would earn just in the month of January, 10%. Is 10% a lot? Huge. Why is that? What do you earn a whole year in the S&P 500? 10%. And here, you earn it by doing what? Following a simple, straightforward strategy. Small is beautiful. Buy the small stocks, short the large stocks, no investment, you earn 10%. Does everybody know this? Every single person in the planet knows this. Well, if everybody knows this, comes the end of December, what should happen? Oh, people should start bidding up the price of the stock to reflect that. So I'm not going to wait till December 31st. Why is that? Because everybody knows I'm going to do it December 30th. No, I'm going to do it December. So guess what happens? If everybody knows this information, and it is true, by the end of December, prices should be where? High enough so that you don't earn any abnormal return, and the evidence is that you do, and you continue to do it. Now, listen very carefully though. It's not as if you hold it for January, somebody writes you a check. That doesn't happen. You have to buy it, hold the investment, and there's lots of variability attached to it. But you earn it on a risk-adjusted basis. What does that mean? Subtract out the betas, and you still earn abnormal So why is this an anomaly? The question is, why does it persist? So the persistence of the January effect is explained in one of two ways. One way, the market is not efficient. That's the answer. I mean, this is a rejection of market efficiency. The other answer is, I'll listen carefully, small stocks are riskier even when you adjust for their betas. Now, if they're riskier, you're certainly entitled to what? A higher return, isn't that right? The problem with that is, this is bad for the beta people, isn't that right? Because beta doesn't do what? Summarize all the risk. So is it possible to tell whether this result shows the market is inefficient or that small stocks are riskier? It's impossible to tell. Anybody who tells you they know the answer to that is not telling you the truth. So it's an anomaly. Is it a rejection of market efficiency? It's possible, but it's not clear. The second example of an anomaly is what I call, not what everybody calls the low PE effect. The low PE effect. Low PE effect is what? Ah, yes, I forgot. It's the loser effect. Why is it the loser effect? Because it says buy stocks with what? With low price earnings ratios, the ones that have very poor growth prospects. So for example, if you align your firms over the past 5 years, highest price earnings ratios to lowest price earnings ratios. If at the end of 5 years, you buy stocks with the lowest price earnings ratios, you earn an abnormal return over and above the firm's beta. So this is the loser effect, and what's the investment strategy? Buy the dogs, right? Buy the bad stocks. So what's the answer? This is if everybody knows this, why doesn't the stock price get bid up to reflect the fact that low PE stocks earn abnormal returns, and then in the future they won't? And the answer is, once again, one of two answers. Either the market is not efficient, or low PE stocks are really riskier. If they're really riskier, then you're entitled to earn an abnormal return. The problem with that is, then beta doesn't fully reflect all the available, all the measure of risk. Does anyone know whether it is market inefficiency or low PE stocks are riskier? The answer is no one knows for sure. So I can't tell you, and neither can anyone else. So these anomalies, in fact, may contain an element of truth. So I'm going to give you a caveat, a warning about anomalies. Ready? Here we go. There is an alternative explanation for all these anomalies, and that is something called data mining. What does data mining mean? People spend all of their waking hours trying to figure out to get an edge in the stock market. And if there are enough people looking for it, they will find it. For example, I know that the human brain is what? Very, very imaginative. What do? We look up in the night sky and we see animals. Okay? So the human mind is so creative that, ready? Here we go. If you torture the data long enough, it will confess. You work on the data, you will find something that worked in the past. Will it necessarily work in the future? Not clear. So do these things work in the past? Yeah. Will they work going forward? I can't tell you. The late, great Fisher Black used a biblical analogy. He said, seek and ye shall find. In other words, there are so many people looking for every crumb of information to extract in the marketplace. They will, of necessity, find patterns that work. And ready for this? Just like if we had 1 billion monkeys pounding away on 1 billion computers, for 1 billion years, it is virtually certain that one of them will come up with the most famous lines in English literature. Here's the last one. Beauty is truth. Truth, beauty, that is all you know on earth and all you need to know. For an eighth, everybody's heard of those lines, right? For an eighth of a point, don't say anything yet. I heard you, Miss Cambria, wait a second. An eighth of a point, I want two things. Who said it, and what was the name of the poem? First, who said it?
John Keats.
Perfect. John Keats. By the way, she redeemed all of you. Now, what was the name of the poem? His best, by far, before Miss Cambria gets a double eighth. Anybody? Where are the English majors? You're hiding them. Yes. Oh, that's so good. Give her an one. Oh, what a great poem. So why did I bring this up? I bring this up because there may be some truth. There may be some truth in the anomalies that we're going to take into account when we do investment strategy. The last point, and then I'm going to open it up for questions from all of you. What does strong form efficiency mean? Strong form efficiency means prices not only reflect public information, it reflects private information, information that has not been made public. So you say, how is that even possible? The answer is, everybody looks at prices. And as soon as they see the price of a stock going up and the others in the same industry not going up, you know what they say? Uh-oh, somebody knows something. Somebody has some good information and they're buying very quietly. So what does everybody else do? They get on the bandwagon and they too bid up the price of the stock. So it's at least conceptually possible for non-public information to get embedded in the stock. The problem is it's almost impossible to test this directly because the people who have the private information won't tell anybody. And if they do, it's usually on the witness stand and they wind up in jail. So we have to test this indirectly. And it's not a great test, but we pay people to do this, to ferret out information legally. Who do we pay? Mutual fund managers. This is what you pay a mutual fund manager to do. Ferret out information that would earn abnormal returns. And they will have to do it legally. What's the evidence about mutual funds? What does that mean, the evidence? If they, in fact, are good at their job and ferreting out information, what should they do? Earn abnormal returns. What's the evidence? Here's the evidence in a nutshell. Listen carefully. You go back over the past 10 years, 20 years, however many years you want to go back. 60% of mutual fund managers are beaten by a simple buy and hold strategy of the S&P 500. What's the S&P 500? A non-managed portfolio. Isn't that right? You just buy the stocks based on their market capitalization, the way we did the way we talked about in an index fund. If you buy an index fund and close your eyes and never trade, you beat 60% of mutual fund managers. Now, is that because it's harder to pick winners than to pick losers? Well, if the market's efficient, what should you at least get? 50-50, isn't that right? If the price reflects all available information and you buy one, you should earn 50, but you should get half the people who buy it should be underperform and half should overperform. Why does the buy and hold strategy beat 60%? 60% of mutual fund managers do worse. And there's one answer. It's something that we've ignored most of the semester. It's called transactions costs. Mutual fund managers try to do better. How do they try to do better? They buy what they think is going down, they sell what they think is going to go down, and they buy what's going up. In point of fact, they have no skill in doing that, but in the process, what do they eat up? Transactions costs. As they buy, they force the price up a little. As they sell, they force the price down. We're not talking about commissions. We're talking about bid-ask spreads. as they buy, they pay the bid-ask spread. As they sell, they pay the bid-ask spread, and they move the price up and down. So transactions costs of mutual fund managers eat away at the returns, whereas a buy and hold strategy, what's a buy and hold strategy? I buy the stock, I don't do anything. I save on transactions costs. Is that the sad fact? It is the sad fact of life. Mutual fund managers do not outperform. Managed funds don't give you their money's worth. So the last question, and then I open it up, the last question is, why do people keep on buying managed mutual funds? Before you came into this class, most of you had never heard of an index fund. Maybe you heard of Fidelity's Magellan Fund. Okay? So why do people ever buy a fund that has an active manager? Why don't they buy an index fund and sit back and relax? What makes people buy managed funds? There is a one-word answer that everybody in this room is familiar with. A one-word answer that everybody in this room is familiar with. What is that word? Yes? They're lazy. They're lazy? Maybe, but if they're really lazy, they will buy an index fund. It's something that you are all very, very interested in, Mr. McCallum.
Risk?
Mr. Enria? Ms. Conversion? Slow? Rafa? Oh. Why am I the one who has to mention the word marketing? Did you forget about marketing? That's why people keep on buying brand name mutual funds. Because they look good, they sound good, and so on. All right. Questions on market efficiency? Am I going to get royalties on that? Am I getting royalties on that?
For this recording?
Yeah.
Sure, if you want to.
I want to make sure. Yes.
Could you talk more about the difference between historical data and all public data?
Okay, so the question is historical data versus all public data. The only time I mention historical data is on the weak form, and that's because it deals with historical prices. The semi-strong form says it's the same thing, but it's any information. Historical prices means the price 5 years ago, 4 years ago, and a minute ago. Okay? So it's all the information embedded in prices. You can take out the word historical. Okay? You don't know future prices. You only know past prices. So weak form efficiency deals with the history of prices. It's a very narrow issue of efficiency, whereas semi-strong form is anything that is publicly available. Okay? Yes?
At the beginning, you said that academics are skeptical that you can outperform based on do it consistently on a risk-adjusted basis and output transaction costs.
Yes.
Can you explain further the risk-adjusted basis?
So the question, so I said you have to be, academics believe that it is very difficult to outperform consistently. What does consistently mean? Don't show me that you outperformed the last 3 weeks, the last 3 months, the last 3 years. You want to tell me about 5 years? You can tell me about 5 years, but I want to be very clear now. Just because a mutual fund was the best performer over the last 5 years is not evidence that there is any skill there. Why is that? There always has to be a winner. So in other words, if you array the past 5 years and get the best mutual fund performer, how do I know whether that was due to skill or luck? What's consistency? Oh, let's start counting from now and see whether you are in the top 1% in every year going forward. So history, consistency is not just 5 years. It has to be not because I picked the winners in the past. There's no evidence that picking winners in the past produces winners in the future. So consistency on a risk-adjusted basis. Risk-adjusted basis is when you get the abnormal returns. What's abnormal? The return minus the beta-adjusted return. If you have a mutual fund if you tell me the mutual fund has earned double the S&P 500 over the past 5 years, is that an example of market inefficiency? And my first question is, what is the beta of the mutual fund? Because if the beta is 3, then they're not earning an abnormal return, they're underperforming. So you have to risk adjust every performance.
So the return minus what you are owed based on the.
Based on the riskiness of your stocks, which is why, for example, the loser effect or the January effect raises the issue: are the small firms in January that you identified riskier? If they are riskier, you're entitled to earn an abnormal return. You're entitled to earn a return for risk. If the losers, low PE stocks, are riskier, you're entitled to earn more than on a completely random portfolio. So you have to risk adjust every performance. One word of caution about risk adjustments, something called selection bias. Hedge funds, people look at hedge funds and they outperform on a risk-adjusted basis. In other words, you take all the hedge funds over the past 10 years, take the data today, look at their returns, they outperform on a risk-adjusted basis. What does that mean? They earn double, but their beta is 1.5. Is that evidence of market efficiency? Be very careful. Because lots of the hedge funds that started out, listen carefully, didn't make it. And if you had invested in the beginning in a portfolio of all hedge funds, your returns would have done what? Reflected the ones that didn't make it. You didn't count those going back because they weren't in your data set. Make sure, and that's called selection bias. Why is that? I count only the winners. Well, if I count only the winners, of course I'm going to earn abnormal returns. So whenever you see evidence of abnormal performance, you have to worry about at least 2 things. One thing you have to worry about is what's the risk? And second, is it suffering from selection bias? And transactions cost, there was a famous result about 5 years ago of a group of, an investment club that reported, earning 32% when the S&P 500 went up by 20%. How'd they do that? We said they got the price over here and the price over there, and they compared it. And they said, well, what about the cost of buying and selling? Oh, we didn't include that. You have to. You must take out transactions costs. Why is that? In order to take advantage of your ideas, you have to buy and sell. Every time you buy and sell, you push up the price a little, you push down, you buy at the offer, you sell at the bid. Those little things look small, but when you add them all up at the end, they take away from your performance. What else?
Do these theories, are they based on the assumption that everyone in the market, all buyers and sellers, are either educated and experienced investors or have portfolios being managed by someone like that?
Okay, so Ms. McWilliams says, are these theories? And these aren't so much theories as the empirical evidence. It's not a question of what I think. I think that I think that markets are efficient. My reason is I believe there are a lot of people who do it, and I look at the evidence. Does everyone have to be sophisticated? Does everyone have to have that information? And the answer is absolutely not. All I need is a sufficiently well-financed group of investors who are motivated to ferret out information. For example, security analysts. Can a security analyst earn abnormal returns? Sure. That would not be abnormal. That would be a returns to her wages, to her time. If you invest time, it is possible for you to find something that you can exploit. By the time she tells you, or the firm that hires her tells you, it's too late.
You compare compare performance from a buy and hold strategy versus a mutual fund, let's say, are you factoring in capital gains taxes, short-term and long-term? And if not, why? Because I know it affects.
Yes,
greatly.
and this should be done after tax, absolutely, and that hurts the mutual fund performance also,
Sure.
because they're always doing, they're subject to much more capital gains and losses than what's embedded in the index fund.
So is that factored into the
Yes,
performance?
yeah, you'll get returns after tax, before tax, it'll be both. It'll be both. Yeah.
Why is it called the January effect and like does it not happen in September?
That's correct, it only happens in January.
Why?
Well, that's a good question. Give him an eighth of them. That's the last eighth. It's appropriate for Mr. Erdman to get those. So, why is it called the January effect? Some people think that it's associated with tax selling. So, in other words, small firms, a lot of people try to realize losses because losses get favorable tax treatment. So there are a lot of sales of stocks that aren't doing well towards the end of December. The small firms have the widest bid-ask spread, so those go down by much. So you can buy at low prices and then sell at the end. And there's another bit of evidence on this in Australia. The tax year ends June 30th. Does anybody know this? I made it up. No, it's true. And the January effect in Australia is July. Okay, so there is something to the tax selling. One last question, Ms. Cardinal.
What's your personal investment strategy?
What's my own personal investment strategy? Ms. Cardinal says, all right, let's go on to the summaries.
Yeah, and I just wanted to clarify for the weak form, if you project.
Say it again, what?
For the weak form efficiency hypothesis, whatever it's called,
Yeah, right. You call it yeah, it's a hypothesis of weak form efficiency. Right. So I said that almost the overwhelming evidence is the market is weak form efficient, which means we were able to reject that you can earn abnormal returns. But I said that there were anomalies there as well. Momentum effects, reversal effects. So I caution you when you hear anomalies that it may suffer from data mining. Things that worked out in the past, but don't necessarily hold in the future. All right, now we're gonna go.
I have a good one now.
What's that again?
I have a good one.
Have a good one.
Yeah.
We didn't go there yet.
I know, it's a good question.
Oh, you have a good question.
Yeah, I think so.
Okay, by the way,
It's possible.
I gotta worry about you. It's like saying something, I have a funny joke. Let them be the judge.
Let me be the judge. So if Small went to the mirror on the wall, would the mirror reply, "You're the fairest" or "option"?
Oh, that's good. All right, eights are off now. I'm going to give you two summaries. I'm going to give you a summary of the entire semester in 9 minutes. And then I'm going to give you a summary of your investment strategy. So you say, well, if you could summarize this semester in 9 minutes, which I will do, why didn't I do it in the beginning? And the answer is, listen, you would not believe me. You would not believe what I'm about to say. So what I'm going to do now is, I think, show you how much you know. You know a lot, okay? But I don't want you to forget what you didn't know. I don't want you to forget what you thought in the beginning. And I'm going to remind you now. So here's what I'm going to ask you to do. Put your pens and pencils down. This one, you don't need to know this. I want you to sort of take this in. All right? And I'm going to remind you of what we said in the beginning. There are 4 principles of finance. Isn't that right? Present value, option value, risk and diversification, and arbitrage. And what I'm going to show you now is 2 things. First, what's obvious, what you may have known about these things before you came into the class. And then I'm going to show you what you know that is far more sophisticated. So let's start. Present value. What did we say present value is? Time is money, okay? What could you have known before? What might you have known? You know, present value has something to do with bonds. Okay? Anybody who thought about a bond, well, it's present value, interest rates, and stocks. But less obvious, and also true, that you know to be true, there are present value calculations in all derivatives. We talked about present value in swaps because of the underlying securities of swaps. And we also saw the present value factor in options. You know the option that we had for the CEO? We said her minimum value, the total value of the option was what, 2813? The minimum value was 1647. Where did 1647 come from? All from the delayed payment of the exercise price, all leverage, all interest. So are options something that you can forget about present value? Right in there, very, very powerful. Second, option value. You learned about option value, and we talked about, we said it, keep your options open. Options are good, okay? What's obvious? You may have heard of puts and calls, okay? You may not have liked them, but you may have heard of them beforehand. Less obvious, but that you know now to be true, options are hiding everywhere. They're in every corporate bond. They're in every municipal bond. They are in every single mortgage that you take out. Options are ubiquitous. And of course, you know why that's important. The power of downside protection, downside protection, downside protection. And if you ever want to remember how powerful downside protection is in your life, you'll think of Eli Manning and the Hail Mary pass at the end of the game. That's why he takes such a risky strategy, because he has downside protection. And then let's turn to risk and diversification. I put those together. Now I'm going to separate each one. First, diversification. What's obvious that you may have known before? You probably had some vague notion, or what do we say, you know, what it was grandma's advice. Grandma's advice, don't put all your eggs in one basket. What did she mean? If things are negatively correlated, you can diversify. If something is good when everything goes bad, that's going to reduce your risk exposure. That's possible to have thought about before. Less obvious, but also true is uncorrelated risks. Diversify. What are the uncorrelated risks? Remember the crazy biology professors. Remember them? Venture capital firms find 100 crazy people who are doing things that are what? That are uncorrelated. And that's why the venture capital fund has such low risk. Zero correlation is as good, if you have enough investments, as negative. What about the risk adjustments? Well, if you thought about risk, you say, well, I don't like risk, and therefore, if a stock is risky, I'm going to penalize it by paying a lower price. So that's not such a bad intuition. But you almost never would have thought that you do not penalize the company for idiosyncratic risk. You do not penalize the company for the risk that its advertising campaign will be especially bad. Why is that? Because in general, people are well diversified, and what? When one advertising campaign is not good, another one will be good. If you're holding a well-diversified portfolio, it doesn't matter. So you only penalize for systematic risk. And finally, arbitrage. What's arbitrage? Buy cheap, sell expensive. What's obvious? It's a way to make money. No question. Okay? You've heard of arbitrageurs. They're rich. But what we discovered is that the principle of arbitrage is underpins all the pricing formulas that we use. So for example, when we talked about spot foreign exchange versus forward foreign exchange, and we said the interest rate parity formula, I know it was before the midterm, but that was based on arbitrage. You know what the forward rate, how the forward rate is related to the interest rates. What else? The price of coupon bonds and zero coupons. How was that? An arbitrage argument. Black-Scholes, a very sophisticated formula. What's the underpinning? Arbitrage. And of course, a zero beta portfolio. How, if you had a zero beta portfolio, how much should you earn? Risk-free rate. That's a lot. And if you know those things, and I think you know every single one of them, you are far more sophisticated and far more able to carry on a normal, intelligent conversation in a group of people who never heard of downside protection. So when you're in a meeting and they're talking about a strategy that has downside protection, we talk about options. All right, now comes investment strategy. So all of the examples that we gave this semester of present value, option value, risk and diversification, and arbitrage, all of those things, most of these things, go into corporate finance as well as investment, but all of the examples were in investments. So what I'm going to do is tell you, what do we conclude about our investment strategy? And what I'm going to do now is tell you what my investment strategy is, based on the things that we have all gone through this semester. And if you want to write, you can. If you don't want to write, that's also okay. So what's the investment strategy? What are the principles that you should look at when you are thinking about how to invest? The most important principle is your best assumption is markets are efficient. Why is that? We all, including me, are consumers of information. We are not working in this industry full-time. If you're working in this industry, then you can, in fact, uncover information and you make the market efficient. But for me, I have to assume that prices in the marketplace fully reflect all the available information. Why is that? People get paid to do this and do it full-time. All right. That's one. Markets are efficient. Don't look for bargains unless it's your full-time job. Second big principle in your investing strategy, exploit the only continuously available free lunch. There is a free lunch. There is a free lunch. And that's called diversification. So I'm going to suggest that the single most important decision that you make with respect to, and now I'm going to be very clear, this is with respect to your risky assets, stocks, bonds, whatever you want to call it, okay? Diversify. How should you diversify? I'll tell you how I diversify. 50% of my risky assets, so I'm only looking at risky assets now, okay? 50% of my risky assets is in an index fund that is in the S&P 500. If you don't like the S&P 500, you could do the Russell 2000. I don't care. But you have one, an index fund. So hold an index fund. Be sure that it is something called a no-load fund with minimum management fees. Why is it? Load funds have a sales fee. You do not want to pay that. It means it is just money off the top. It doesn't give you any benefit. Minimum management fee, why is that? Management fees take away from your returns and add nothing. Nothing. All right? 50% of your net worth, of your risky assets, should be in an index fund. And I would also suggest strongly that you should have 20%, 5% of your risky assets in international funds. Why is that? Because they are underrepresented and they are great diversifiers. So you should have some invested in a European index fund, some invested in an Asian index fund. And finally, because there may be some truth in the anomalies, there may be I would put 25% of my net worth in small capitalization funds. Why is that? Small is beautiful, big, okay? I don't know for sure. I don't think doing that will hurt you very much. And you'll say, well, how did I get 50, 25, 25? The answer is I made it up. You want to do 60, 20, 20, that's okay too. And if you want to do, what's this? 70, 15, and 15, that's also okay. Just make sure you are well diversified domestically, internationally, and also maybe take into account small capitalization or the low PE anomaly. The next step, C, customize your risk with the X factor. What's the X? X is the fraction of your net worth in risky securities. Where are risky securities? Those are the ones in B. Okay? And what should the X factor be? X factor says you take, let's say, if X is 70%, that means 70% of your net worth should be in risky mutual funds. The other 30% should be in treasury securities, earning almost nothing. What's the right number for X? Whichever number allows you to sleep well at night. There is no right number, remember, it depends upon your degree of risk aversion. So it could be, X could be 70, X could be 80, X could be 40, depending on your degree of risk aversion. And the final step, the most important step, is do not, underline it 30 or 40 times, do not try to time the market. What's time the market mean? Adjusting X when you think stocks are going up. If X is 70% in your normal times, you think stocks are going to go up, you raise X to 100%. If you think stocks are going to go down, you lower it to 10%. Do not do that. You will be wrong more often than you will be right. Why is that? Market's efficient. Do not try to time the market. Those are the principles of investment which I use, that I think if you think back throughout the semester, this is what you learned. Now, I know that you are smart enough and have learned enough to in fact buy into A, B, and C. None of you will follow me. The lure of trying to beat the market is too great, and we all think we know something about the future. So if you can't help yourself, here's what you should do. When your analysis of politics and economics and world affairs and everything else suggests that the market is going to go up in the future because it is a great environment, that is when you should sell. And when your analysis shows that this is going to be a terrible future for the stock market, why is that? All bad things are going to occur, and stocks are going to do terribly. What should you do? Buy. Why is that? Be a contrarian. Why is that? Because if you think that, guess who else thinks that? Everybody else. And if everybody thinks it's good, what is everybody doing? Everybody has already bought. And now what is that? Prices already reflect all the good news that you could possibly think of. And if it's down, it's terrible, prices have already reflected that they are that things are terrible, and that's when you want to buy. So in other words, you want to be a contrarian. What's the problem with being a contrarian? We all want to be contrarians. You're never sure that you're being a contrarian is really not what everybody else is thinking at the exact same time. Therefore, do nothing. And just as a last word of caution, why is it so hard to beat the market? Why should you keep a steady hand on the tiller, don't move it around so much? Long-term price-earnings ratios, over the long run, price-earnings ratios are around 16, okay? And we know that what? Price-earnings ratio reflect people's expectations about growth. You have to write the price-earnings ratio formula. So let me just give you just a minute of history. In 1982, when the S&P 500, listen carefully, was 100. You know what the price-earnings ratio was? About 7. You know why? The world was coming to an end. Because inflation in the United States was 12% a year. So the worst news was there. What should you have done in 1982? Buy stock. Why is that? What's the S&P 500 today? Around 1,600. If you bought that at 100 and just held it, you would have 16 times your money. On the other hand, in the year 2000, you know what the price-earnings ratio was? 30. Why was it 30? The internet was going to produce a new era, and it did. And you know what? Stock prices already reflected that. What was the S&P 500 in the year 2000? 1,500. What was it 2 years later in 2002? 800. Where is it today? We just passed. It's past month. We're now at 1,600. Why is that? Things looked so good in 2000. Stock prices already reflected that information. So my advice to you is, today we're at 1,600. Check the price-earnings ratios, and good luck. The problem steps on either side. I had a good time.